Question 1. Topic: Life insurance basics. Adverse selection. Adverse selection is a significant concern in the life insurance industry. Which of the following scenarios best exemplifies adverse selection? A healthy individual purchases a term life insurance policy after reviewing multiple quotes. B. A young individual in excellent health purchases additional coverage as their income increases. C. An individual with a known terminal illness decides to purchase a high-value term life insurance policy. D. An elderly individual renews their existing term life insurance policy without any changes to coverage. Answer: C. Explanation. Adverse selection occurs when individuals with a higher risk of requiring life insurance benefits disproportionately purchase or renew policies, which can lead to significant financial strain for insurance companies. In option C, an individual with a known terminal illness purchasing a high-value term life insurance policy is a classic example of adverse selection. This is because the individual knows they are more likely to make a claim soon, increasing the likelihood of payout. Option A describes normal market behavior without elevated risk. Option B shows someone increasing coverage due to improved financial circumstances, not health risk. Option D refers to a simple renewal without a change in risk profile. Regulatory oversight and careful underwriting are essential in managing adverse selection in insurance. Insurers often use medical underwriting and premium adjustments to mitigate these risks. Question 2. Scenario-based topic. Claims and benefits. Contestable period. Mr. Stevens purchased a term life insurance policy 2 years ago. He passed away recently and his beneficiaries have filed a claim. During the claims process, the insurance company discovered that Mr. Stevens misrepresented his smoking status in the application by stating he was a non-smoker, but he was actually a heavy smoker. Which of the following actions is the insurer most likely to take under Iowa state regulations regarding the contestable period? A. The insurer will pay out the full death benefit as the contestable period has ended. B. The insurer will rescind the policy and refund the premiums paid due to material misrepresentation. C. The insurer will deny the claim and keep all premiums due to the misrepresentation. D. The insurer will pay out a reduced benefit after adjusting the premiums for a smoker's rate. Answer: D. Explanation. In Iowa, a policy is generally incontestable after it has been in force for 2 years. After this period, the insurer cannot void the policy entirely for misrepresentation except in cases of fraud. However, in this scenario, the insurer discovered Mr. Stevens' misrepresentation after the contestable period, so they cannot completely rescind the policy. They are more likely to adjust the death benefit based on what the premiums would have been if Mr. Stevens had correctly reported his smoking status. Option A would be correct if there had been no material misrepresentation, but in this case there was. Option B could apply if the misrepresentation was discovered within the contestable period, but that period has passed. Option C is not correct because the insurer cannot deny the claim outright after the contestable period unless fraud is involved. This approach aligns with industry practices and regulatory standards for life insurance, which aim to balance fairness to both the insurer and the policyholder. Question 3. Topic: Taxation of life insurance. Modified endowment contracts. Which of the following is a key characteristic of a modified endowment contract? MEC under life insurance tax law. A. The policy accumulates cash value but is always taxed as ordinary income upon death benefit payout. B. Distributions from ME C before the age of 59. 1. 2. May be subject to both income tax and a 10% penalty. C. Premiums paid into a ME C are tax deductible up to a certain limit. D. ME C is designed primarily to provide long-term care benefits with tax advantages. Answer: B. Explanation. A modified endowment contract (MEC) is a life insurance policy that fails the 7-pay test, meaning it accumulates too much cash value too quickly. As a result, distributions, such as loans or withdrawals, taken from the cash value before the policyholder reaches age 59. 1. 2. Are subject to ordinary income tax and may incur a 10% IRS penalty. This rule exists to prevent life insurance policies from being used as tax shelters. Option A is incorrect because death benefits from a ME C are generally not taxed as ordinary income, or they retain the tax-free status of life insurance death benefits unless the estate is subject to estate tax. Option C is false because life insurance premiums are not tax deductible. Option D confuses MECS with long-term care insurance, which may offer tax benefits but is not related to ME/C rules. Understanding MEC rules is essential because they alter the tax treatment of life insurance policies, affecting how policyholders access and manage cash value. Question 4. Topic: Policy provisions, options and riders, non-forfeiture options. If a policyholder decides to stop paying premiums on a term life insurance policy and the policy has built up cash value, which of the following non-forfeiture options allows them to maintain life insurance coverage for a reduced benefit without further premium payments? A. Cash surrender value. B. Reduced paid-up insurance. C. Extended term insurance. D. Waiver of premium. Answer: B. Explanation. The reduced paid-up insurance option allows the policyholder to use the cash value to purchase a reduced amount of paid-up insurance. No further premiums are required, and the policy remains in force for the rest of the policyholder's life, albeit for a smaller death benefit. Option A. Cash surrender value means the policyholder receives the cash value in a lump sum and the policy terminates. Option C. Extended term insurance allows the policyholder to use the cash value to purchase term insurance for the original face amount but for a limited period. Option D. Waiver of premium is a rider that waives future premium payments in case of disability but does not affect the non-forfeiture options. Non-forfeiture options ensure that the policyholder does not lose all benefits if they stop paying premiums on a policy that has built up cash value. Question 5. Scenario-based. Topic: Iowa state-specific regulations, misrepresentation. MS Davis, an insurance producer, is discussing life insurance policies with a potential client. To make the policy more appealing, she implies that the policy guarantees high investment returns, even though the policy does not explicitly state this. A few months later, the client realizes that the returns are much lower than expected. What action can be taken against MS Davis under Iowa's unfair trade practices regulations? A. No action can be taken because the policy was sold and the client signed the contract. B. MS Davis could face disciplinary action for misrepresentation under Iowa insurance regulations. C. The client can cancel the policy but will not receive any compensation for the misrepresentation. D. The insurer will be required to increase the policy's returns to meet MS Davis's verbal guarantees. Answer: B. Explanation. In Iowa, misrepresentation by an insurance producer is considered an unfair trade practice under state law. If an agent provides false or misleading information about a policy, they can face disciplinary actions, including fines, license suspension, or revocation. MS Davis could face these penalties for suggesting the policy had guaranteed high returns when it did not. Option A is incorrect because misrepresentation in the sale of insurance is illegal even if a contract was signed. Option C is partially correct, but the client may also have the right to other remedies, including cancellation and compensation. Option D is incorrect because the insurer is not obligated to honor verbal guarantees made by the producer if they contradict the policy terms. This emphasizes the importance of full and accurate disclosure in insurance sales under Iowa's regulations. Question 6. Topic: Underwriting and policy issue. Conditional receipts. A client submits a life insurance application and provides the initial premium payment along with the application. The insurance company issues a conditional receipt. Which of the following best describes the insurance company's obligation under this type of receipt? A. The insurance company is obligated to provide immediate coverage regardless of the underwriting outcome. B. The insurance company provides coverage if the insured meets the insurability requirements as of the date of the application or medical exam. C. The insurance company is not obligated to provide coverage until the policy is issued and delivered to the insured. D. The insurance company will only provide coverage after the full underwriting process is completed, regardless of any receipt issued. Answer: B. Explanation. A conditional receipt provides that coverage begins on the date of the application or medical exam, whichever is later, but only if the insured is deemed insurable according to the company's underwriting standards. If the insured dies before the underwriting process is completed but was insurable at the time of application, the insurance company is obligated to pay the death benefit. Option A is incorrect because the insurer only provides coverage if the insured meets the underwriting criteria. Option C describes a binding receipt, not a conditional receipt. Option D is incorrect because conditional coverage is provided based on meeting the underwriting standards, not completion of the process. This highlights the importance of understanding the distinctions between conditional and binding receipts in life insurance. Question 7. Topic: Policy replacement and cancellation. Free look period. Under Iowa life insurance law, how long does a policyholder have to review a new term life insurance policy and cancel it without penalty during the free look period? A. 10 days. B. 15 days. C. 20 days. D. 30 days. Answer A. Explanation. Iowa law provides a mandatory 10-day free look period for life insurance policies, during which the policyholder can cancel the policy for any reason and receive a full refund of any premiums paid. This allows the insured time to review the policy terms and decide if they want to keep the coverage without being locked into the contract. Options B, C, and D are incorrect because Iowa mandates a 10-day period for most life insurance policies, though some longer periods may apply under specific circumstances. The free look provision is a consumer protection measure that gives policyholders the chance to fully evaluate their policy. Question 8. Topic: Taxation of life insurance. Taxation of group life insurance. Which of the following statements is correct regarding the taxation of employer-provided group term life insurance? A. The entire death benefit is taxable to the beneficiary as income. B. Employer-paid premiums for coverage amounts exceeding $50,000 are considered taxable income to the employee. C. Premiums paid by the employer for any amount of group life insurance are fully tax deductible to the employee. D. Employer-paid premiums for all coverage amounts are considered taxable income to the employee. Answer B. Explanation. For employer-provided group term life insurance, premiums paid by the employer for coverage amounts exceeding $50,000 are considered taxable income to the employee. The IRS views this as a fringe benefit, and the cost of coverage over $50,000 must be included in the employee's income and is subject to income tax. Option A is incorrect because death benefits are generally not taxable as income to the beneficiary. Option C is incorrect because only premiums for coverage above $50,000 are taxable, not the full premium. Option D is incorrect because premiums for coverage up to $50,000 are not taxable to the employee. This rule ensures that high-value employer-paid life insurance coverage is subject to fair taxation. Question 9. Topic: Insurance company operations. Stock companies versus mutual companies. What is one key difference between stock life insurance companies and mutual life insurance companies? A. Stock companies issue dividends to policyholders, while mutual companies do not issue dividends at all. B. Mutual companies are owned by policyholders, while stock companies are owned by shareholders. C. Stock companies provide only group life insurance, while mutual companies only offer individual policies. D. Mutual companies are required to maintain higher reserves than stock companies. Answer B. Explanation. The key difference between stock and mutual life insurance companies lies in ownership. Mutual companies are owned by their policyholders, who may receive dividends as a return of excess premiums. Stock companies, on the other hand, are owned by shareholders, and dividends are paid to shareholders rather than policyholders. Option A is incorrect because mutual companies do issue dividends to policyholders. Option C is incorrect because both stock and mutual companies can offer both group and individual policies. Option D is incorrect because the reserve requirements for both types of companies are regulated similarly by state insurance laws. This distinction affects how profits are distributed and how the company is managed. Question 10. Topic: Disability income insurance. Elimination period. Which of the following best describes the elimination period in a disability income insurance policy? A. The period during which benefits are payable to the insured. B. The period before the insured becomes eligible for benefits after a disability occurs. C. The total duration of the policy's coverage. D. The time during which the insurer may contest a claim due to misrepresentation. Answer B. Explanation. The elimination period, also known as the waiting period, is the amount of time the insured must be disabled before they can begin receiving benefits from the disability policy. It functions similarly to a deductible, but in terms of time rather than money. Option A is incorrect because the elimination period is the time before benefits are payable, not during the benefit period. Option C refers to the overall coverage period, not the elimination period. Option D refers to the contestability period, not the elimination period. The elimination period helps reduce premium costs by limiting the insurer's liability for short-term disabilities. Question 11. Scenario-based topic: Life insurance riders. Accidental death benefit rider. Mr. Thompson has a $200,000 life insurance policy with an accidental death benefit rider that doubles the payout in case of accidental death. While on a hike, Mr. Thompson dies from a heart attack. How much will his beneficiary receive from the insurance policy? A. $200,000. B. $400,000. C. $0 as heart attacks are not covered under the policy. D. $100,000. Answer A. Explanation. The accidental death benefit rider only pays an additional benefit if the insured dies due to an accident. Since Mr. Thompson's death was due to a heart attack and not an accident, the accidental death benefit does not apply. The beneficiary will receive the basic death benefit of $200,000, but not the additional $200,000 from the rider. Option B is incorrect because the heart attack does not trigger the accidental death benefit. Option C is incorrect because the policy still pays the base death benefit for a non-accidental death. Option D is incorrect because the policy amount is $200,000, not $100,000. This highlights the importance of understanding policy riders and their specific conditions. Question 12. Topic: Types of policies. Universal life insurance. Which feature of universal life insurance distinguishes it from other types of life insurance policies? A. Fixed premiums for the duration of the policy. B. The ability to adjust the death benefit and premiums. C. Guaranteed cash value growth. D. Benefits are only paid if the insured dies within a certain time frame. Answer B. Explanation. Universal life insurance is known for its flexibility, allowing policyholders to adjust both the premiums and the death benefit over time. It offers the potential for cash value growth based on interest rates, but the premiums and death benefits can be changed depending on the policyholder's needs. Option A describes whole life insurance, which has fixed premiums. Option C is incorrect because universal life insurance does not guarantee cash value growth. It depends on interest rates. Option D describes term life insurance, not universal life insurance. This flexibility makes universal life insurance appealing to those who want to adjust their policy as their financial situation changes. Question 13. Topic: Policy loans. Interest on policy loans. When a policyholder takes out a loan against the cash value of a life insurance policy, what is the impact of unpaid loan interest on the policy? A. Unpaid interest is forgiven after the first year. B. Unpaid interest accumulates and is added to the loan balance. C. Unpaid interest does not affect the policy in any way. D. The insurer cancels the policy if interest is not paid immediately. Answer B. Explanation. If a policyholder does not pay the interest on a policy loan, the unpaid interest is added to the loan balance, increasing the total debt owed against the policy. If the loan balance including interest exceeds the cash value of the policy may lapse. Option A is incorrect because unpaid interest is not forgiven. Option C is incorrect because unpaid interest does affect the policy by increasing the loan balance. Option D is incorrect because the policy is not immediately cancelled, though it may lapse if the loan exceeds the cash value. Policy loans allow access to cash value, but policyholders must manage them carefully to avoid potential lapse. Question 14. Topic: Policy provisions. Incontestability clause. The incontestability clause in a life insurance policy prevents the insurer from voiding the policy for misrepresentation after how long? A. 1 year. B. 2 years. C. 5 years. D. 10 years. Answer B. Explanation. The incontestability clause in most life insurance policies stipulates that after 2 years, the insurer cannot void the policy or deny a claim due to misrepresentation on the application except in cases of fraud. Option A is incorrect because the typical period is 2 years, not 1 year. Options C and D are incorrect because the period is generally shorter than 5 or 10 years. This clause provides protection to the policyholder after a set period, ensuring claims are honored if the insured survives beyond 2 years. Question 15. Scenario-based topic: Property insurance. Replacement cost versus actual cash value. A homeowner's policy includes replacement cost coverage for personal property. After fire destroys a 5-year-old television which had an original purchase price of $2,000, the insurer determines that a comparable new television would cost $1,500 today. Will the homeowner receive under the replacement cost coverage A. $2,000, the original purchase price; B. $1,500, the current cost of a comparable new television; C. $1,000 after depreciation is applied; D. Nothing, because the TV is too old to be replaced. Answer B. Explanation. Replacement cost coverage reimburses the homeowner for the cost of replacing the item with a new one of similar kind and quality without a deduction for depreciation. In this case, the homeowner will receive $1,500, which is the current cost of a comparable new television. Option A is incorrect because replacement cost is based on the current cost, not the original purchase price. Option C describes actual cash value coverage, which deducts for depreciation. Option D is incorrect because replacement cost coverage applies regardless of the item's age as long as it is a covered loss. This coverage ensures the homeowner can replace damaged property without out-of-pocket losses due to depreciation. Question 16. Topic: Insurance regulation. NAIC model laws. Which organization develops model laws for states to use as guidelines for regulating the insurance industry? A. Federal Insurance Office, FIO. B. National Association of Insurance Commissioners, NAIC. C. Securities and Exchange Commission, SEC. D. Internal Revenue Service, IRS. Answer: B. Explanation. The NAIC develops model laws and regulations that states can adopt to create uniformity in insurance regulation across the U.S. These model laws serve as templates that states may modify and implement in their own jurisdictions. Option A is incorrect because the FIO is a federal agency, but it does not create model laws. Option C is incorrect because the SEC regulates securities, not insurance. Option D is incorrect because the IRS handles taxation, not insurance regulation. The NAIC helps ensure consistency in insurance laws, though states retain the authority to regulate insurance within their borders. Question 17. Topic: Health insurance, coordination of benefits. When an insured individual has coverage under more than one health insurance plan, which provision determines the order in which the plans pay claims? A. Elimination period. B. Primary coverage rule. C. Coordination of benefits. D. Deductible clause. Answer: C. Explanation. The coordination of benefits provision helps prevent overinsurance by determining which plan pays first, primary coverage, and which plan pays second, secondary coverage. This ensures that the insured does not receive more than 100% of the claim amount. Option A refers to the waiting period before benefits begin. Option B is not a recognized insurance term. Option D relates to the out-of-pocket amount the insured must pay before benefits begin, not the order of coverage. This provision is essential when an individual has multiple health insurance plans, ensuring proper coordination of payments. Question 18. Topic: Health insurance, pre-existing conditions. Under the Affordable Care Act account, what is the status of pre-existing condition exclusions for health insurance policies? A. Pre-existing condition exclusions are allowed, but only for the first 12 months of coverage. B. Pre-existing condition exclusions are allowed if the insured was uninsured for more than 63 days prior to coverage. C. Pre-existing condition exclusions are not allowed under any circumstances. D. Pre-existing condition exclusions are only allowed for individuals over the age of 65. Answer: C. Explanation. Under the Affordable Care Act account, health insurance companies are prohibited from denying coverage or charging higher premiums due to pre-existing conditions. This rule applies to all non-grandfathered individual health insurance policies issued after the ACA's passage, ensuring that individuals with pre-existing conditions have equal access to health insurance coverage. Option A is incorrect because the ACA completely prohibits exclusions for pre-existing conditions, regardless of the duration of coverage. Option B is incorrect as pre-existing conditions cannot be excluded even if the individual was uninsured for an extended period before acquiring coverage. Option D is incorrect because the prohibition on pre-existing condition exclusions applies to all individuals, regardless of age. This key provision of the ACA protects individuals with medical histories from discrimination in health insurance. Question 19. Topic: Policy provisions. Incontestability clause. After how many years from the policy issue date does the incontestability clause prevent an insurer from voiding a life insurance policy due to misstatements in the application? A. 1 year. B. 2 years. C. 3 years. D. 5 years. Answer: B. Explanation. According to the incontestability clause, after life insurance policy has been in force for 2 years from the date of issue, the insurer cannot void the policy due to misstatements made by the policyholder in the application except in cases of fraud. This provision ensures that once the policy reaches its second anniversary, the insurer's ability to challenge the validity of the contract is limited. Option A is incorrect because the standard period is 2 years, not 1. Option C and D are incorrect as the incontestability period is legally set at 2 years, not 3 or 5. Question 20. Topic: Policy riders, waiver of premium. Which of the following situations would typically NOT qualify for the waiver of premium rider on a term life insurance policy? A. The insured becomes disabled and cannot work for more than 6 months. B. The insured loses their job due to company layoffs. C. The insured is involved in an accident that leaves them permanently disabled. D. The insured suffers a terminal illness and is unable to work. Answer B. Explanation. The waiver of premium rider typically allows for the policyholder's premiums to be waived if the insured becomes totally disabled for a specified period, usually 6 months. This rider does not apply to job loss due to company layoffs, as this is not related to the insured's health or ability to work due to disability. Option A, C, and D all describe situations related to disability or terminal illness, which would generally trigger the waiver of premium provision. Question 21. Scenario. Topic: Beneficiary designations. Mr. Rodriguez names his wife as the primary beneficiary and his daughter as the contingent beneficiary on his term life insurance policy. If his wife predeceases him, what happens to the death benefit upon Mr. Rodriguez's death? A. The death benefit will be paid to Mr. Rodriguez's estate. B. The death benefit will be paid to his daughter. C. The death benefit will be paid to his wife's estate. D. The death benefit will be divided between Mr. Rodriguez's estate and his daughter. Answer B. Explanation. When the primary beneficiary, his wife, predeceases the insured, the death benefit will be paid to the contingent beneficiary, his daughter. The contingent beneficiary only receives the benefit if the primary beneficiary is no longer living at the time of the insured's death. Option A is incorrect because the contingent beneficiary takes precedence over the estate when a contingent beneficiary is named. Option C is incorrect since the primary beneficiary's estate would not receive the death benefit unless named as a beneficiary. Option D is incorrect because the death benefit goes entirely to the contingent beneficiary, not divided between the estate and the contingent. Question 22. Topic: Life insurance basics. Viatical settlements. In a viatical settlement, who typically purchases the life insurance policy from the terminally ill insured? A. The insurance company. B. A viatical settlement provider. C. A financial advisor. D. The insured's beneficiaries. Answer B. Explanation. A viatical settlement is an agreement where a third-party viatical settlement provider purchases the life insurance policy from a terminally ill insured at a discounted rate. The provider becomes the new owner and beneficiary of the policy and receives the death benefit when the insured passes away. Option A is incorrect because the insurance company is not involved in purchasing the policy in a viatical settlement. Option C is incorrect as financial advisors do not purchase policies in these transactions. Option D is incorrect because the insured's beneficiaries do not typically buy the policy. Question 23. Topic: Iowa state-specific regulations. Misrepresentation. What would constitute misrepresentation by an insurance agent under Iowa law? A. Explaining the differences between term life and whole life insurance policies. B. Presenting a term life policy as a whole life policy to a potential client. C. Offering a policy that has exclusions for risky activities such as skydiving. D. Not discussing a competitor's policy during a sales presentation. Answer B. Explanation. Misrepresentation occurs when an insurance agent knowingly provides false or misleading information about the terms, benefits, or coverage of an insurance policy. Presenting a term life policy as a whole life policy is an example of misrepresentation, which is prohibited under Iowa law. Option A is incorrect as it is the agent's duty to explain policy differences accurately. Option C is incorrect because exclusions are common and legal as long as they are disclosed truthfully. Option D is incorrect since agents are not required to discuss competitors' policies. Question 24. Topic: Life insurance basics. Estate conservation. Which of the following is not considered a primary reason for purchasing life insurance for estate conservation? A. To pay estate taxes. B. To replace lost income for the insured's family. C. To fund charitable donations. D. To provide liquidity for the insured's estate. Answer B. Explanation. Estate conservation focuses on preserving the value of the estate for heirs by providing liquidity to pay estate taxes, settle debts, or fund charitable donations. Replacing lost income for the insured's family is more aligned with survivor protection, not estate conservation. Option A, C, and D are all valid estate conservation purposes, whereas B is a separate purpose tied to income replacement. Question 25. Scenario. Topic: Underwriting process. Ms. Thompson applies for a term life insurance policy and completes the medical exam. During the underwriting process, it is discovered that she has a family history of heart disease. Which risk classification is she most likely to receive? A. Preferred risk. B. Standard risk. C. Substandard risk. D. Decline. Answer: C. Explanation. Ms. Thompson is likely to be classified as a substandard risk due to her family history of heart disease, which could indicate a higher likelihood of future health issues. This classification typically results in higher premiums or coverage limitations. Option A is incorrect because a preferred risk classification is generally given to applicants with excellent health and no significant family medical history. Option B is incorrect since standard risk is for average applicants without major medical issues. Option D is incorrect as the family history of heart disease alone may not result in a declined application. Question 26. Topic: Taxation of life insurance. Cash value accumulations. What is the tax treatment of cash value accumulations in a whole life insurance policy? A. Taxable as ordinary income annually. B. Tax deferred until withdrawal. C. Tax-free as long as the policy is in force. D. Taxed at capital gains rates upon withdrawal. Answer: B. Explanation. The cash value accumulation in a whole life insurance policy grows on a tax-deferred basis. Taxes are not due on the accumulated cash value until it is withdrawn or the policy is surrendered. Option A is incorrect because cash value is not taxed annually. Option C is incorrect because the cash value becomes taxable if withdrawn. Option D is incorrect as the withdrawal is taxed as ordinary income, not capital gains. Question 27. Topic: Policy riders. Accelerated death benefits. Under which of the following circumstances would an insured most likely trigger an accelerated death benefit rider? A. The insured is diagnosed with a terminal illness. B. The insured reaches the age of 65. C. The insured has been disabled for more than 6 months. D. The insured loses their job and needs financial support. Answer: A. Explanation. The accelerated death benefit rider allows the insured to access a portion of the death benefit early if diagnosed with a terminal illness, typically with a life expectancy of 12 months or less. Option B is incorrect because reaching a certain age does not trigger this rider. Option C is incorrect since disability triggers the waiver of premium rider, not the accelerated death benefit. Option D is incorrect as job loss does not qualify under this rider. Question 20. Topic: Insurance company operations. Mutual companies. How are mutual life insurance companies distinct from stock life insurance companies? A. Mutual companies issue dividends to stockholders. B. Mutual companies are owned by their policyholders. C. Mutual companies are for-profit entities. D. Mutual companies can only sell group life insurance. Answer: B. Explanation. Mutual life insurance companies are owned by their policyholders rather than stockholders. This means that any profits made by the company are typically returned to the policyholders in the form of dividends or used to reduce premiums. In contrast, stock life insurance companies are owned by shareholders who may receive dividends, but policyholders in stock companies are not entitled to these profits. Option A is incorrect because mutual companies do not issue dividends to stockholders, and they issue dividends to policyholders. Option C is partially true but does not distinguish mutual companies from stock companies, as both can be for profit. Option D is incorrect because mutual companies can sell both individual and group life insurance, not just group insurance. Question 29. Topic: Underwriting and policy issue. Risk classification. An individual applies for a life insurance policy and is classified as substandard risk. What does this classification typically imply? A. The individual is denied coverage due to poor health. B. The individual will pay higher premiums due to increased risk factors. C. The individual qualifies for lower premiums because of excellent health. D. The individual will receive the policy with a waiver of premium rider automatically added. Answer: B. Explanation. As substandard risk classification means that the individual poses a higher risk to the insurer, typically due to factors such as health conditions, dangerous hobbies, or occupation. As a result, the insurance company will charge higher premiums to compensate for this increased risk. Option A is incorrect because a substandard risk classification does not necessarily result in a denial of coverage. It typically leads to higher premiums. Option C is incorrect because low premiums are reserved for individuals classified as preferred risk. They're not substandard. Option D is incorrect, as a waiver of premium rider is not automatically added for substandard risk individuals. It is an optional rider that may or may not be available depending on the policy. Question 30. Scenario. Claims and benefits. Death benefit settlement options. Mrs. Lee, the beneficiary of her husband's life insurance policy, is reviewing the settlement options provided by the insurance company she wants to ensure that the death benefit provides her with a steady income for the rest of her life. What settlement option should she choose? A. Lump sum payment. B. Fixed period installments. C. Interest only option. D. Life income option. Answer. D. Explanation. The life income option guarantees Mrs. Lee a steady stream of payments for the rest of her life, regardless of how long she lives. This option provides long-term financial security, ensuring that the death benefit will last for her entire lifetime. Option A is incorrect because a lump sum payment provides the entire death benefit at once, which would not provide ongoing income. Option B is incorrect because fixed period installments are paid over a specified number of years, not for the beneficiary's lifetime. Option C is incorrect because the interest-only option pays only the interest on the death benefit, leaving the principal untouched, which may not meet Mrs. Lee's goal of long-term income.